Today, we're going to dig into the topic of physical climate risk, what it is, what it looks like, and what it means for our portfolios. And we'll kick it off with you, Spencer. You spend a lot of time helping people understand the climate. Can you kind of set the stage a bit and lay out for us where it is that we find ourselves now and how we kind of got here?
Probable Futures is the name of the initiative that I founded. And it is a nonprofit. You can go to probablefutures.org. So just as a place to go. But I'm going to ask a question. It's springtime, or it's about to be springtime. And there's a simple question. Instead of getting into ESG or getting into any of those things, let's just ask a simple question. What grows where? It's going to be spring. What should you plant? Well, very helpfully, the U.S. Department of Agriculture produces this map. And they're called hardiness zones, plant hardiness zones. What grows where? There are all these zones, and the 2023 map is here. It's actually new. It was updated from 2012. And it's actually got 2 new zones. We can talk about why that's true if you're interested. But what I want you to see is there are these climates. Different colors mean different things grow in different places. And this is your guidance for what to grow. Well, the problem is the 2023 map is out of date. Why? Because the 2023 map is based on the trailing 30 years of data. So they figure out what grew well in the past 30 years and what temperature and weather patterns were in the last 30 years, and they take an average. So, well, that's an average that's actually quite outdated. This is the global service, the temperature of the atmosphere going back to 1850. We have really good records, and we have slight different estimates about the past, but you can see there was long stable period there from 1850 to 1925, and it starts going up, and then it really starts going up in the 80s. Why does this matter for the plants? Well, because the USDA is using this window, 1993 to 2023, to tell you what to plant. And the average during that time was about 1 degree C above that 1850 to 1900 average. Whereas now we're at 1.5. So what does that mean? Well, if you look at a map, this is a map of the number of nights when the temperature dropped below freezing, called frost nights. This is from the probablefutures.org platform. And we're just going to take the center of the country. We're going to take Topeka, Kansas. In the past, in an average year, there were 94 nights when it was below freezing. In a warmer year, there were 35. And in a cooler year, there were 148. That's the 5th and 95th percentile. So actually, there are tails outside of that. But this is what climate is. It's ranges. And this was the range for a long time in Topeka. So what you see at the top there is 0.5 degrees C, the past, that purple caret by past. That's roughly the temperature in that period of the middle of the 20th century. So this is technically 1971 to 2000. So this is the weather they're used to. It's a pretty wide range. Kansas has pretty funky, wild weather. But what happened when the whole atmosphere warmed from 0.5 to 1 to this data? Well, the number of frost nights dropped quite a lot. But I'm going to go back and show you. The warmer year goes from 35 nights to now it's down to 26, and the average goes from 94 to 88. And it still might have a lot of cold nights, but this range has changed. That's 1, which is what is represented in the new maps. 1.5, you see we lose even more. And so there's many fewer frost nights. Well, that matters for what you plant. Also thinking ahead, since we will in all likelihood be at 2 degrees C before too long, what does 2 degrees look like? Well, it's now getting quite different in Topeka. What grows there is going to be quite different than in the past. And if you go to 2.5 or 3 degrees C, you see really big changes in these distributions. So that's about cold. Let's talk about hot, and then I'll hand it back to the rest of the group. So days above 95 degrees Fahrenheit. That's hot. All of our bodies are around 97, 98 degrees Fahrenheit. So once it gets close to our body temperature, it's a little bit rough. Hot summers in Topeka. 21 days on average in the past, above 95. In a hot year, be like 50 days. And some years wouldn't have that many. But look what happens to this data as it gets warmer. 1 degree, 1.5. Now we're talking about an average year of 35, and in a warmer year, more than 2 months. And as temperatures go up, these get quite substantially different. At 2 degrees, it's now 40, 66, and that range is super wide. And if you get to 3 degrees C, it really is radically different. And so what grows there is going to be very different. So why does this matter? Well, it matters because for a long time, the climate was stable. It was so stable that the same trees grew in the same place for a super long time. Trees actually allow us to know a lot of history. because we can look back, for example, at when was their peak cherry tree blossom in Kyoto, Japan, which is famous for them, going back to the 800s. What you see is it went up and down in a range, but where we are now is much earlier. So cherry trees are blossoming much earlier, and the trees are undergoing strain that they weren't undergoing before. What does this look like? Well, a friend of mine sent me a picture in February in Berlin where the cherry trees aren't sure what to do. It's February, they shouldn't be blossoming, but it was 70 degrees, and so they blossomed. This gives you a feel for how the climate is changing and how we also know that it was stable. And that's the thing here. Climate change matters because for roughly 12,000 years, the climate didn't change. So from 10,000 BCE to 1850, the average temperature of the atmosphere was constant. It was a very narrow range of 1 degree either way. And that allowed us to plan, to build civilization, to have building codes, all the rest. And what's happened is if you get out of that narrow band, things get funky. So what happened before 9500 BCE? The climate was very unstable, which is why humans were mobile. And we had this long period when we're settled. And where are we now? Well, we've left that band. At 1.5 now, we are outside the band that we've been in for 12,000 years, and it's going to have impacts. So I'll pass it back, and we can continue the conversation.
Thanks, Spencer. Super helpful. So Jeff, Spencer showed us very practically how the climate is changing, right? And looking around the world at wildfires and droughts and heat waves, flooding, it's very clear that extreme weather is becoming more frequent and more severe. So how do you think about physical climate risk in the real world and how it impacts our daily lives?
Yeah, so I can start with the idea that a lot of financial analysts for the past 100+ years have looked at multiple forward-looking data sets to try to project how to invest around market returns. They've looked at political likelihood. They've looked at even crop yields during a stable temperature. They look at all kinds of variables to make assessments, and none of those variables are very certain. One of the much more certain variables that you can look at today is actually climate projections. As much as people want to argue about what the cause of climate change is, the reality is that the models that we've been using since 1970 have become more and more accurate over the last 50, 60 years, to the point where projections from 1970, even from Exxon's own projection models from 1970, have been almost dead on accurate to the temperatures that we're seeing today. So as a forward-looking projection model, climate is probably one of the safest things that you could utilize to start thinking about risk in your models going forward. And one of the easy examples that we could talk about is food, because as Spencer was just saying, we're seeing growing cycles change, we're seeing planting cycles change, we're seeing pressure on crops and yields, we're seeing issues where workers in hotter climates can't work as long hours during the day. All of that is inflationary. You don't have to make a specific bet about an agricultural basket to understand that climate change is inflationary to the markets. There's many examples of this across the board. So we've got the demand on renewables, and I would add in AI to that. So AI seems like an unstoppable train at this point. The demand on the energy grid to meet current orders for chips, just to manufacture those chips and provide the data centers for them, is off the charts to the grid that a lot of states, especially where most of these plants are being built, like New York, Georgia, and Virginia, can handle that new demand load. Renewables also add demand load because there's rare earth metals and precious metals that are needed. EV vehicles need more precious metals and rare earth. So there's these demands coming in. And the one thing we know from basic economics is that prices are reflective of supply and demand. So we have demand going up. We have supply on agriculture being affected. And then the really a simple example to look at right now is what's going on in the Panama Canal. Right now in the Panama Canal, because of severe droughts in that area, the amount of shipping is down about 35% of the number of ships that can go through the canal on a daily basis. Now, those ships then have to find other routes. They have to go through the Suez Canal, which is about a 45 to 90-day additional cycle for those ships to transport. And all of those additional trips and those longer log miles and that reduction in transportation is increasing cargo pricing. And what we've been saying for the last 2.5 years is that because of the way we look at climate change, we think inflation is going to be much stickier and around for much longer than the markets are expecting it. And lo and behold, last week's CPI print and today's PPI print were all higher than expected. And we're seeing the markets not want to digest that. But if you're not looking at it from a climate lens, it's easy to see why you might not digest that. You might think a lot of it is transitory and it's going to be worked out, or we're going to have a recession and it's going to cut that out. But even in a recession, climate change is affecting all of these issues, food prices. And the last example I would give is reinsurance. Reinsurance rates last year are up 37%. And that is a direct result of high claims being paid through really 17 through 21, 22. That's roughly a 37% increase from 17 to today on reinsurance premiums. Those reinsurance premiums have to go somewhere. They don't get absorbed by the reinsurance company. Reinsurance companies are in this business for a profit, so they get passed on. And what are we seeing? Well, insurance companies are regulated by the state. Reinsurance companies are not. So insurance companies who are regulated by the state can't absorb and pass on those premium increases from the reinsurance companies. So their choices are to stop issuing insurance coverage in those areas. And what we've seen over the last 2 years is insurance companies leaving California, Louisiana, and Florida in droves. Not one company, not two companies, dozens of companies leaving, and the biggest companies leaving. And the states are having to absorb all of that, which ultimately will increase risk, will drive property values down in this case, ultimately, because no one wants to buy a house where you can't get insurance coverage on. So there's lots of risks that are just very like good tells. You know, this is just a space where it's hard for me to understand why people don't want to look at it, because the risk is actually much easier to measure and much easier to predict how it's going to affect different investment cycles.
Yeah, just to pick up on that, I used to be so I worked for 18 years at one of the biggest investment firms in the world, Wellington Management, where I was actually the director of investment research. So I oversaw research across all different parts of the firm and understood what models were good models and what models were bad models. And I'm going to share my screen again, because what I wanted to share is that I came to realize that in finance, people were using generally not very good models. Financial models are, if they're better than 50%, they're pretty useful. But it's a lot of dart throwing. But these models were really accurate. And so I became fascinated with the fact that we had one really good forecast that nobody was using. And people were using lots of bad forecasts that they had dreamed up themselves. They were looking for candle pins, and they were looking for all kinds of, different indicators that they thought would work. And in the meantime, these science models that just portray how physics works were getting this right over and over again. And I was embarrassed to not be using them. So I'm going to talk a little bit now about why, put a little bit of specificity to some of the things that I think Jeff really importantly highlighted. And so, as I said, everyone's trying to predict the future in finance, and climate models just have a better track record than any economic or financial models. The other thing that this tells us is that a stable climate is the foundation of civilization. Nomads do not have capital. You need to be able to plan in place for there to be capital. Capital is about investing for payoff in the future. So you need to have a view about the future, and not and if we think climate is going to get more and more uncertain, or more and further from where we are now, and in particular, if too many people ignore it. And one of the ways that's embodied is architects and builders, they don't study climate. They use building codes. So the grades of asphalt everywhere, the size of storm sewers everywhere, the materials, the size of the HVAC system. Maybe some of the people on this call have been to London now in the summer, or Paris in the summer, and all of those buildings don't work. It's brutal. I've been in the city of London when the doors on the outside of the buildings were open, even though it was 95 degrees outside, because it was hotter inside the buildings than outside. The reason is they weren't expecting 95-degree weather. in London. And so they built everything about the past. This is especially true for insurance. It is all based on backward-looking data. In fact, to talk about the regulations that Jeff mentioned, in many states, insurers are prevented by law from using any model except backward-looking data. They are not permitted by law to do anything except take an average of the past. This is why they're backing away. Is they know the risks have risen, but they're not allowed to reprice the risk. And talk about reinsurance. Well, the reinsurance markets are not regulated, exactly as Jeff said. They have been using this data earlier. And three things are happening to risks. One is that risk probability of hazards has gone up. The second is the correlation between them has gone up. So there are hot years or years when more things happen all at once in more places. In the past, insurance treated hurricanes, droughts, downpours as being uncorrelated, but there's so much evidence that they are correlated that it's harder now to build a portfolio. And the third is the scale is so much bigger that what's happening in insurance is losses that are so big, no one wants to be responsible for them. And I think it's a really important point when talking about real estate, which is where this is most important, is that real estate is property damage and property insurance for real estate is only for the physical structure. It's not for the land value. And land value is what will change the most. So I'm now going to talk about a specific insurance, which is the USDA crop zone. Remember, I showed you that map at the beginning. Those backward-looking things, they are the basis in the US that insurers have to use for crop insurance, even though we now know they're outdated. What did scientists get right? This is from the early 1980s. Experts began telling us that this was about to start accelerating in a big way. That's fine. We can talk about the averages. They were very right. But what's more impressive is the specifics they were right about. That when weather got hotter, it would get more humid, hot weather, because every 1 degree centigrade or 1.8 degree Fahrenheit that air warms, it can hold 7% more moisture, which means that 18 degree warmer air in Fahrenheit holds 100% more water. That's why there's more drought and more deluge, more dry and more extreme, but less gentle showers. They said that temperatures would rise faster near the poles. This has been exactly right. This has big implications. The seasonal patterns will change. So winter will get much shorter and the other seasons will get funkier. That's very important for agriculture because when rain falls is so important. This is one of the inflationary effects that we're seeing for in the ways that Jeff's talking about. And just generally less mild weather and more extremes. And so what does this mean, more hot and humid weather or more drought and deluge? This is a map of the likelihood of a year plus extreme drought. This is an example of the changes that come with even moderate increases in temperature, because that each increase in temperature involves more pulling of water out of the land and the plants and more long dry periods followed by more deluges. This is the likelihood of year plus extreme drought. So this is the kind of drought that would really affect agricultural prices, would hurt farms, and it happened on average about once every 20 years. So there's a 5% risk. What you can see is it's indexed around the world so that a drought in Houston is different than a drought in Vancouver, which is different than a drought in Berlin. It's certainly different than a drought in the Amazon, but each place, all those building codes, all those plants are attuned to that place. Just going from 0.5 to 1 degree C, all of a sudden you see these places where drought becomes an 11 to 20% chance. You say, well, only went from 5 to 11 to 20. That's the difference between once in a generation and once every 5 to 10 years. That is a huge change. And when you go to 1.5, which is where we are now you see all these places where it's a 21 to 33% chance. That's every few years. That's no longer a drought. That's called aridification. It's just the drying out. And these are the places where we're already seeing dramatic effects of drought. And these are pretty much irreversible changes that we now need to adapt to. And this is not a message that the future is hopeless. It's a message that if we don't start adapting, though, if we don't start planning around this, incorporating it, we're going to keep being surprised by inflation, by floods, by insurance pulling away. But if we engage with it, we can figure out how to live well in this. And if we don't decarbonize, over time, look what happens. At 2 degrees C, it becomes brutal. Look at Central America there. And at 2.5 or 3 degrees, it's very hard to figure out how we don't have massive unrest globally from this challenge. And so these are the stakes. And I think this underlies why it's first inflationary, and then it sort of upsets the markets. But eventually, if we don't deal with it, it will wind up being much more substantial.
Great. Thank you, Spencer. Super helpful. So I guess this is a question for both of you, but maybe Jeff, I'll start with you. So how, in light of all of this information, how can advisors talk to their clients about this topic? How can they start to incorporate this lens into their practice?
Yeah, I mean, it is difficult for advisors to address this. I mean, one, they're politically being swayed by information that they're getting. Two, unfortunately, we're in a world where sound bites drive everything these days, so that's become a problem. Real deep education is harder. I spoke to a group of 100 professional older men the other day and asked how many people had spent a reasonable amount of time studying climate change to understand their position and belief on climate change, and not one person raised their hand, which was interesting because they were there to see a presentation on climate change and had specific opinions and beliefs about it, but they were able to at least admit that they hadn't put really any work into forming those beliefs and opinions. So with clients, it's touchy because you don't want to touch a raw nerve. We have conversations with clients that say the climate is changing. We don't talk about what's driving it. We don't start with a political conversation about it. We say that there are specific factors that we can see in the environment that show that the climate is changing, that things are getting warmer, and that's driving to evidence and results that Spencer has been talking about. And we think there are investment opportunities and risks around those changes that are easily trackable and predictable. So investing in water, most people, especially in the Midwest and in the West, don't have any difficulty understanding that there are issues with water. Secondly, infrastructure. And we start with the fact that, especially in the US, our infrastructure is incredibly aged. We are at this point, we're almost becoming a senior country, not like Europe, but we're getting there. And our infrastructure is on average 75 to 100 years old in most places. And that has to be replaced. And because of all the issues that Spencer has been talking about, it has to be replaced with different infrastructure than what was built the first time around, because there's more water or there's less water or there's more heat. All of these factors affect the infrastructure, the building codes, and we're seeing issues around the country crop up around that. So we also talk about insurance because clients are seeing their insurance premiums come up, especially in states like Florida, Louisiana, where it might, and Texas, where it might be difficult to talk about climate change. It's not difficult to start a conversation about insurance premiums. We have clients who are really upset that they moved somewhere where property taxes and insurance premiums were 60, 70% lower than New York and New Jersey when they left. And now all of a sudden they're creeping right up and passing where they were, where they left. We have literally a case just recently with a client who lives in a community in Colorado. It's a large multifamily community, and that community's HOA coverage. So if you live in a condo complex or a townhome complex, you have an HOA policy. You don't each individually have insurance. Their HOA policy told them they weren't going to renew back in September of last year. They went out to bid. They had 4 companies bid. There was a wildfire that was within 2 miles of the development while the bid was going on. 3 of the companies dropped out of the bid. The 4th company that remained, which they had to take that policy, 13x'd the premium. So not a 13% increase, they 13x'd the premium and only offered a 9-month policy. For sale signs are now popping up in that community because for a lot of people, these are second homes that they don't have to deal with the fact that they can't sell it if they can't get insurance on the property. So we go right at very tangible dialogue and conversation. We also have been writing for 2.5 years that climate change has been going to be inflationary, and we keep being proved right on the inflation prints, where the rest of the market sees inflation dropping off much more rapidly.
I want to piggyback on a couple of those things. I think that for people to engage with this, to start with, there's a reason I started with plants and buildings. Everybody who is got any assets is likely to have some physical assets in particular places: a home, a second home, a real estate, a rental investment, some other, own a REIT, whatever. Those are places to just start asking these questions. Just say, so what is this building built for? What was the plan? What is the grade of asphalt? How big is the storm sewer? I mentioned London. London's initial storm sewer was built for just a 1/4 inch of rain a day, because that's how much they thought would be a lot. They actually increased it to be just 2 inches of rain a day. Well, it's rained 2 inches a day several times in the last couple of years, which it never did before. And it meant that all the basement flats in London flooded. And so the city is actually losing housing stock instead of gaining housing stock when it has really high rents. And I think these are questions that are just very straightforward. What are we assuming? One way to think about this is people think they may not want to use climate models, but they have their own model. Everyone has a model in their head, and their model is basically it's going to stay the same, or I don't need to pay attention to this. If your own model is it's just going to be like before, you're competing in a market where people are using intelligence that you're not, and you're very unlikely to win. And so what I can say very with high confidence is there are people now in markets that are relevant: reinsurance, catastrophe bonds, the insurance market in general, but also in parts of banking and other parts of the markets that are now incorporating this data and behaving in ways that the rest of the market is surprised by. And like Jeff, I have a catalog of these surprises of people coming to me. Is this why I need to this? Is this why? Yes, this is why. Start asking those questions. And I do think there's one other thing to focus on here, which is Jeff's example of the insurance bidding process there is really important. It's amazing that they only offered a 9-month policy. It's very telling. Why? They're leaving out one season. They know what the season is they don't want to insure for. So it used to be that you could get a year, but nobody would offer you insurance longer than a year. So one of the things to look at in your investment portfolio is where is what I would call a temporal or duration mismatch. You have a long-term investment that you think of as long-term, but it's dependent on 1-year insurance plans. You say, well, it's gone up, but it's only gone up 10%. But what if it goes up 10% every few years? What does the longer curve look like? The insurance company has no obligation to tell you that curve. You have an assumed change that's just a one-time change. And this gets to the last thing that I want to highlight about Jeff is taxes are going to go up in all of the places where the climate is changing the most. Because there were a bunch of essentially environmental services that were planned for we expected to get nice days, outdoor recreation. Think about how much of sports is already moving indoors. And that's way more expensive than outdoors. This idea of substituting for the climate or rebuilding because of the climate is something that no municipality or state planned for. And so these budgets are woefully underprepared for disaster relief, for repair and maintenance, and especially for replacement of things that were basically free before. And so just starting with where you live, where you own assets, and asking these questions of your managers, well, what are you doing about it? What questions are you asking? What tools are you using? What is your model? And if it's, it'll all be fine, maybe you should probably find a better manager.
If I could add just one thing to that, it's also when we have conversations about REITs and municipal bonds, it's a very easy conversation because right now there's no risk premium in the market. And while there's no risk premium, it actually means that you can look at these maps and forward-looking forecasts that Spencer's pointing to, and you can say, okay, I probably don't want to own a lot of real estate in Houston. So I can look at maybe 5 REITs that all have the same yield and same kind of pool of assets underneath. Maybe it's all multifamily housing. And I could say, all right, I'm going to go more northeast. I want to avoid California. There's a lot of wildfires. I want to avoid Houston. There's a lot of flooding. I want to avoid Florida, Louisiana. So I can cherry pick because there's dozens, if not hundreds, of REITs out there. I can use a filtering process and a risk process to look at the REITs that have properties that are limited to those high exposure areas. And what we explain to a client is that, let's say, even if you think I'm wrong, if there's no risk premium paid in that and no return give up in that model, why take the risk? If I'm right, you're ahead of the game. If I'm wrong, you're even. There's no loss in that example. If you want to own a municipal bond pool and you have a choice of a bond in Rochester, New York, that's a hospital bond that's yielding 3.5%, is A-rated, or you have one in Tampa, Florida, that's 3.5%, 20-year bond, A-rated, why pick the Tampa bond right now in case you're wrong? So those conversations are easier to have, because if we're right, that risk premium, unfortunately, the markets move really slowly and then all at once. So that risk premium doesn't get priced in slowly. When the market gets smart about something, it prices it in like a cliff. So why not get ahead of it now?
Yeah. And
Yes.
I'll give the reason I left finance was to create public tools that would allow people to do this. So the maps you saw in my presentation are all from our website, probablefutures.org, which is taking the best climate models around the world and just making them accessible to anybody who wants to ask these questions so that the markets work better. So yes, we're a nonprofit organization, but the main goal here is to get people to make better decisions. You say, well, that's not fair to the people in Houston to move away. Well, putting more capital in Houston when it's more in peril is a bad social policy, and financing capital in places that are more actually sustainable or will endure fewer pressures signals how to move capital out away from high risk and into better opportunities. And so these tools were theoretically public, and what's happened is some people are paying boutiques to give them climate intelligence while everybody else is using no information. And so the reason we built Probable Futures and with the maps that we did was so that everybody could have a baseline. It's sort of like you could hire a whole quant team to figure out inflation to the detail. But if you have some good ideas and you have access to the Bureau of Labor Statistics print on inflation, you can participate intelligently. You need to be able to have some amount of literacy. And so we actually started as a data initiative, and now we call ourselves a climate literacy initiative, because you need to have this understanding to ask these questions. It doesn't require you get a PhD in science. It requires you just to use your intuition and a bit of information that is very, very intuitive. This is not like AI or CRISPR or something else that very few people understand. It is comprehensible, but you need to make it part of your due diligence, part of your process. And doing that is actually can be fun, can be interesting, can be engaging, makes the world less a bunch of spreadsheets and more a place where we actually live.
Yeah. Yeah. Thank you so much, both of you, for your expertise here. We covered a lot today, and I think just the way I'll wrap up is just in simple terms, what are the kind of 2 or 3 key takeaways that you have for advisors when it comes to physical climate risk and thinking about this space?
Yeah, I can start there. I mean, certainly overall themes for us are climate is inflationary. So worry and check your inflation assumptions. 2, there are incredible investment opportunities around grid, infrastructure, renewables, climate, EV transition that are not going away. And the IRA bill is, pushing almost $1 trillion in the direction of those investments. So to not be on board with them with some of your portfolio just does not make a lot of sense. And lastly, think about when you're buying homes and selling homes, where you're buying and selling your home. Maybe renting is a better idea if you want to live on the beach in Florida these days than owning. So there are just very simple adjustments that you can make as an advisor to the dialogue you're having with your clients and to the thinking you're doing about your portfolio.
And from my perspective, I worked in an incredibly resourced high finance situation, and nobody thought about this. And I think it's just good to start and say, this wasn't part of what we did before. We assumed it didn't matter. And now it matters. And so we better figure it out. We better get literate at least about it. And so I think that having that honesty with a client and saying, I didn't think this mattered either, but I figured out that it matters, clearly now matters. We should get up to speed on this. And I think just opening that up as in an honest way, saying, I didn't know, now it's obvious. We need to catch up and we need to figure out what it means. And this isn't about whose fault it is or who should be ashamed of it. It's about the weather changing and the impacts of it. And we didn't really pay attention to the weather, but we have that facility. So I think that's the opening, is say, this didn't used to matter because the climate didn't change, and now it's changing and it matters. So let's learn a bit about it. And then the next part is, all right, what's the first question we're going to ask? Let's start with a building. And I think just starting with a building, starting with something that's, where you live, whatever, it's just a good way to open that door. And once you start doing that, it's easy to move forward. It's hardest to start. And so I think that's the point I would make, is start with it didn't matter, then say, now that it matters, we should probably learn. And then once you do that, all right, let's start with your home. What are the assumptions about your home? And I think that's a good, you'll start talking about, I don't know how big the storm sewer is. I don't know what the municipality planned. I don't really know if that tree is the right tree anymore. Just those type of things to get started. It's a good relationship builder also, and I think it can be a good window.